In this video, we are going to talk about dividend stocks that will make you rich. So before starting, please like this video and subscribe to this channel for our future updates. It's simple to make money in the stock market if you own dividend stocks. According to a 2013 report by JP Morgan Asset Management, publicly traded companies that started and increased payouts between 1972 and 2012 averaged a 9.5% annual return. Over the same 40-year period, non-dividend paying counterparts saw average yearly increases of only 1.6%. Dividend stocks are reasonable prospects for making investors wealthy because they are virtually always lucrative and time-tested. Income seekers desire the biggest potential yield with the least amount of risk. Data reveals, however, that once yields cross around 4%, yield and risk are highly connected. This means that ultra-high-yield businesses are frequently more bother than they're worth. A failing or struggling operational model might snare income seekers with a high dividend yield because yield is just a function of payout relative to share price. However, there is some good news. The following 5 ultra-high-yield dividend companies, which I'm defining arbitrarily as yields of 7% or higher, have the potential to make their shareholders wealthy. Here are the top 5 dividend stocks that will make you rich. So let's start. Number 5. Annaly Capital Management, 10.3% yield. Buying and holding the preeminent name among mortgage real estate investment trusts, REIT, Annaly Capital Management is arguably one of the safest methods to generate wealth over time, NYSE, NLY. Since its establishment more than 2 decades ago, Annaly has paid out more than $20 billion in dividends, averaging a 10% yield over that time. Simply said, Annaly attempts to borrow money at low short-term loan rates and then invest that money in assets with a greater long-term yield, mortgage-backed securities. The net interest margin is the difference between the greater long-term yield and the lower short-term borrowing rate. The greater the profit margin, the more money Annaly can make. Mortgage REITs' net interest margins have historically widened considerably as the yield curve steepens throughout the early years of an economic rebound. This indicates that we found the sweet spot where mortgage REITs outperform. Annaly's other big selling feature is that it has a lot of agency securities in its portfolio, $92.6 billion out of a total of $100.4 billion in assets. This means that in the event of a default, the federal government will back the great majority of its assets. This enhanced security enables Annaly to make strategic use of leverage in order to increase profitability. Number 4. Enterprise Products Partners, 7.4% yield. Simply put, the prospect of investing in an oil and gas company after the industry was hammered during the epidemic makes some long-term investors nervous. Enterprise Products Partners, NYSE, EPD, a high-yielding dividend midstream firm, remained unaffected by the pandemic, with a distribution coverage ratio of 1.6 and a 22-year trend of increasing its base annual payout. Enterprise Products Partners' location within the energy complex is its main advantage for investors. Midstream enterprises that supply oil, natural gas, and natural gas liquids transmission and storage capacity usually have consistent cash flow regardless of how well or poorly the economy is doing. Enterprise can complete projects without jeopardizing its cash flow or profitability by relying on transparent fee-based contracts. In the United States, the corporation owns more than 50,000 miles of pipeline and 14 billion cubic feet of natural gas storage capacity. Enterprise Products Partners' propensity to invest in capital expenditures and acquisitions is another element driving its robust dividends. Despite the fact that energy firms are likely to gradually migrate to greener solutions over time, fossil fuels will continue to be a major source of energy for decades. Number 3. Mobile TeleSystems, 11.1% yield. In terms of yield, Russian telecommunications behemoth Mobile TeleSystems is at the top of the list, NYSE, MBT. Keep in mind that MTS dividend is adjusted dependent on the company's operating results. Despite this, it has routinely paid out a dividend of more than 7% per year. The wireless activities of Mobile TeleSystems will remain its bread and butter. Despite the fact that Russia's wireless industry is oversaturated, infrastructural improvements will be critical in boosting organic growth. The implementation of 5G download speeds in Russia's big cities, as well as the ongoing rollout of 4G in Russian suburbs, should generate a long-term technology upgrade cycle that leads to higher data consumption, and data is where wireless companies make the most money. MTS has a number of quickly growing new verticals, including MTS Bank, Pay TV, and cloud services, to mention a few, in addition to the cash flow predictability associated with its wireless business. Active paying TV subscribers increased by 54% to 7.1 million in the last year, while over-the-top subscribers nearly tripled to 2.9 million. In the meantime, income from cloud services increased by 28% year-over-year. Despite the fact that these areas don't generate much revenue right now, they'll almost certainly play a key role in the company's long-term growth prospects. Number 2. AGNC Investment Corporation, 8.8% yield. Isn't it true that the mortgage REIT sector is finally getting its stride? In addition to investing in Annaly, its veritable sidekick, AGNC Investment Corporation, NASDAQ, AGNC, has a great potential to outperform and make its owners wealthy. AGNC's yield hasn't gone below 8% since coming public nearly 13 years ago. AGNC has oriented its portfolio to take advantage of agency mortgage-backed securities in the same way that Annaly has. The company had $62.1 billion in agency-backed residential mortgage-backed securities, RMBS, in the first quarter, excluding to-be-announced securities. Non-agency RMBS and credit risk transfer securities totaled less than $500 million and $1.1 billion, respectively. Without being too technical, just about 3% of total assets are invested in potentially risky long-term assets, which has resulted in a consistent dividend income stream for shareholders. AGNC's investors will also be rewarded with a bonus. Unlike the other companies on this list, AGNC pays a monthly dividend of 12 cents instead of quarterly or twice a year. This payout and the company's book value have capacity to grow if the U.S. economy continues to improve and the yield curve steepens. Number 1. Altria Group, 7.3% yield. Finally, consider adding Altria Group, NYSE, MO, to your portfolio as a brand name tobacco stock. According to data from YCharts, Altria shareholders have received a total return of more than 2,600,000% since 1972. The sale of premium cigarette brand Marlboro accounts for the majority of Altria's revenue, given its focus on the U.S. market. Despite the fact that cigarette shipment volume has been steadily declining over the years as the negative health effects of smoking have compelled some smokers to quit, the addictive nature of nicotine has allowed Altria to increase the price of its premium products. These price increases typically compensate for lower cigarette shipment volumes. Altria is also concerned with life outside of tobacco. It sells smokeless tobacco in a few cities and owns a 45% stake in Cronos Group, a Canadian marijuana company. If cannabis were to be legalized on a federal level in the United States, Altria would almost certainly be a front-runner in developing a leading cannabis vape product with Cronos. Altria's heavy dose of share buybacks and exceptional pricing power make it a dividend stock with all the potential to make its shareholders wealthy, despite the fact that it is no longer a growth stock. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.